Let's get a closer look at the markets with Troy Gayeski, FS Investments Chief Market Strategist. Troy, it's good to have you this morning. You know, S&P 500 sitting on about a 25% gain for the year. For most of this year, nobody seemed happy with it, right? It was the manner in which we were getting those gains. People said it was only 7 stocks. I'll tell you, since early November, it's been anything but that. The average stocks outperformed the index. You've seen cyclicals work. The equal-weighted S&P has actually a pretty solid 14% total return this year. Can it possibly stay good going into next year?
Well, when you think forward, given the fact that the economy remains incredibly resilient, and by the way, I wish you guys gave me the heads up. I would have wore a cool sweater today if I'd known ahead of time. But you know, given the still incredible strength of the economy and the fact that, to your point, valuations to cyclicals and value have not quite caught up, it could continue. Our point now, though, is when you think of valuations, you know, you had the 10-year drop from 5% to 3.8 very, very rapidly. Remember all the concern about budget deficits and funding? They've completely gone away. And you have multiples have re-expanded in the S&P to 20.4 times forward earnings. You know, you're kind of at the tail end of this rally now, and you have to think of ways to diversify yourself, particularly when the correlations or the sensitivity between fixed income and equities have become so high. So yet again, we had, you know, August, September, October, tough month for 60-40. And then November, December, it's been a banner way to close out the year.
It absolutely has. And it does seem as if there's been folks rotating into bonds as they really did have a tough stretch for about, you know, the better part of 2 years. So maybe that kind of rebalancing type activity might be running its course. But how do you do that then? If you sit there and say you have to diversify in other ways besides just, you know, allocating a bit to fixed income?
Yeah, well, you know, it depends on the mandate, the asset allocation target. But if you think about alternative strategies now that look attractive, it's a great time to be a private lender if you have dry powder to lend into a liquidity vacuum. Not only do you have higher front-end rates, and most of these strategies are lending at floating rate terms, but the risk of a recessionary outcome has dropped considerably. So you have more income for longer without the potential hangover of a recession driving higher default rates. And then at the same time, you have the banking system, as you know, the regional and community banks have been forced to retreat dramatically. So that's created a bit of a liquidity vacuum here. And what's so unusual, particularly in real estate now, is you have higher total return potential in the senior part of the capital structure than you do in equity, given the fact that we're in a real estate correction and you have high single-digit return potential in the senior part of the capital structure. So that's one of our favorite alternative expressions or themes right now. In order to grind out a consistent return, make slightly higher returns than cash and fixed income, and not have some of the crazy volatility that we've seen the last 2 years in equity or fixed income markets.
Yeah, I guess, though, if the economy holds together in a way that default rates remain low, as you know, for private borrowers, aren't earnings going to come through okay, do you think, for the S&P 500, even if they don't hit the 10 or 11% projections that we might be looking at officially?
Yeah, if we avoid recession, we're clearly going to continue to have earnings growth. And to your point, the question is whether it's 6 or 8, probably not 12 to 15, but 6 to 8% in that range. So you'll at least get earnings growth looking forward. I think the question now versus, say, 2 months ago at the end of October is, now that multiples are back up to 20.4 times forward earnings, do you sacrifice a little bit of the multiple expansion you've seen the past 2 months, driven partially by that tremendous drop in yields? And remember, in the background, the Fed does continue to drain their balance sheet. You've seen funding cost stresses start to emerge at the end of the quarter. So you can't rule out, you know, a few extra turns of multiple compression, maybe taking multiples from 20.4 back to 18, you know, which basically means you've given back the earnings growth of next year through multiple compression. And, you know, unfortunately, we don't expect the Fed to be cutting aggressively anytime soon. We think they're going to be very patient, make sure that inflation is truly defeated. You know, this cutting cycle is going to look a lot like the hiking cycle of 15 to 18, where the Fed moved very, very slowly. So you really can't count on that Fed put or a dramatic decline in the front end to boost multiples further.